FDIC Insurance refers to the Federal Deposit Insurance Corporation's insurance program, which protects depositors in case of bank failure or closure. FDIC Insurance covers up to $250,000 per depositor per account ownership category at FDIC insured banks and savings associations. FDIC Insurance is funded through premiums paid by member banks and savings associations. The vast majority of banks and savings institutions in the United States are FDIC insured. In this video, we'll explore an overview of Federal Deposit Insurance Corporation's insurance program, the types of account covered under FDIC insurance, and the limitations of FDIC insurance. By the end of this video, you'll have a better understanding of the Federal Deposit Insurance Corporation's insurance program, known as FDIC Insurance. If you're ready, we'll begin with an overview of FDIC Insurance, and later in this video, we'll examine its limitations. FDIC Insurance works by protecting depositors' funds in case a bank or savings institution fails or is closed. When a bank fails, the FDIC steps in to assume control of the bank's assets and liabilities. The FDIC then sells the bank's assets and uses the proceeds to repay depositors. In other words, if a bank or savings institution fails, the FDIC will step in to ensure that eligible depositors receive their money back up to the insured limit. Let's see how FDIC Insurance works step by step. Step 1. FDIC insured banks pay premiums to the FDIC to participate in the insurance program. Step 2. If a bank fails, the FDIC steps in to assume control of the bank's assets and liabilities. Step 3. The FDIC evaluates the bank's assets and liabilities to determine the amount of insured deposits. Step 4. The FDIC then sells the bank's assets and uses the proceeds to repay depositors up to the insured limit of $250,000 per depositor per account ownership category. Step 5. If the bank's assets are not sufficient to cover all insured deposits, the FDIC may use its reserves or borrow from the U.S. Treasury to make up the difference. Step 6. The FDIC will notify depositors of the failed bank and provide information on how to claim insured funds. In Step 1, we mentioned that FDIC Insurance is funded through premiums paid by member banks and savings associations. But how are these premiums calculated? And how are they distributed in case of bank failure? The premiums are based on the bank's deposit base and the amount of risk it poses to the FDIC Insurance Fund. The FDIC Insurance Fund is used to cover the cost of reimbursing depositors in the event of a bank failure. The fund is built up through the premiums paid by member banks and savings associations. The FDIC uses a risk-based system to determine the amount of premiums that each bank must pay. The system takes into account the bank's level of risk as well as the amount of insured deposits it holds. Banks that have a higher level of risk, such as those with a large number of non-performing loans or a high debt-to-equity ratio, will typically pay higher premiums than banks that pose a lower risk. The premiums paid by FDIC-insured banks are deposited into the insurance fund, which is used to cover the cost of reimbursing depositors in the event of a bank failure. The fund is also used to fund the FDIC's operations, such as supervising banks and promoting consumer protection. In summary, FDIC-insured banks pay premiums to the FDIC to participate in the insurance program. The premiums are based on the bank's level of risk and the amount of insured deposits it holds. The premiums are used to build up the FDIC Insurance Fund, which is used to cover the cost of reimbursing depositors in the event of a bank failure. Now, let's explore the limitations of FDIC insurance. Although FDIC insurance is an important safeguard for depositors, it does have limitations. Here are some of the key limitations to be aware of. The first one is coverage limits. The most significant limitation of FDIC insurance is the coverage limit of $250,000 per depositor per account ownership category at each FDIC insured bank. Deposits that exceed this limit may not be fully covered. The second one is non-FDIC insured accounts. FDIC insurance only applies to deposits in FDIC insured accounts, such as checking accounts, savings accounts, money market deposit accounts, and CDs. Deposits in non-FDIC insured accounts, such as investment accounts or accounts held at non-US banks, are not covered by FDIC insurance. The third limitation is time to receive payment. In the event of a bank failure, it may take some time for depositors to receive payment from the FDIC. This delay can be especially problematic for businesses and individuals who rely on their deposits for day-to-day operations. The fourth limitation is exclusions. Certain types of deposits are excluded from FDIC insurance coverage, such as deposits in trust accounts that are not revocable, deposits held by brokers, and deposits held in retirement accounts that are not insured by the FDIC. The fifth limitation is bank eligibility. Not all banks are FDIC insured. It's important to verify that a bank is FDIC insured before depositing funds. And finally, the sixth limitation is economic conditions. FDIC insurance is only as strong as the underlying financial strength of the FDIC insurance fund. In the event of a severe economic downturn, the FDIC may face challenges in meeting its obligations to depositors. In summary, while FDIC insurance is an important safeguard for depositors, it does have limitations. Deposit insurance coverage is subject to coverage limits and only applies to certain types of accounts at FDIC-insured banks. It's important to carefully consider these limitations when choosing where to deposit your funds. Now that we talked about the $250,000 limitation of FDIC insurance, the important question is, what if your deposit is more than $250,000? If your deposit is more than $250,000, it may not be fully covered by FDIC insurance. The FDIC insurance limit applies to each depositor, per ownership category, at each FDIC-insured bank. This means that if you have more than $250,000 in one account ownership category at one bank, the amount over $250,000 may not be covered by FDIC insurance. To ensure that all of your deposits are fully insured, you can spread your deposits across multiple banks or across different ownership categories within the same bank. The FDIC provides information and resources to help you understand how to maximize your deposit insurance coverage. One way to increase your deposit insurance coverage is to use multiple account ownership categories. For example, you could have $250,000 in a single account, $250,000 in a joint account with your spouse, and $250,000 in an FDIC-compliant money market account at the same bank. This would provide you with a total of $750,000 in FDIC insurance coverage at that bank. Alternatively, you could spread your deposits across multiple FDIC-insured banks. This would ensure that each deposit is covered up to the $250,000 limit at each bank. It's important to note that FDIC insurance policies and rules can change over time. While the FDIC tries to keep depositors informed of any changes, it's a good idea to check the FDIC's website periodically to ensure that you have the most up-to-date information. The FDIC website, www.fdic.gov, provides a wealth of information on deposit insurance coverage, including coverage limits, account ownership categories, and exclusions. The website also includes a tool called EDI, or Electronic Deposit Insurance Estimator, that can help you determine your deposit insurance coverage based on your specific account ownership and balance. In this video, we explored the Federal Deposit Insurance Corporation's insurance program. In conclusion, FDIC insurance is a crucial safeguard for depositors that protects their deposits in the event of a bank failure. The FDIC insurance limit is $250,000 per depositor per account ownership category at each FDIC-insured bank, and this coverage can be increased by spreading deposits across multiple banks or account ownership categories. While FDIC insurance is an important protection, it's important to be aware of its limitations and to stay informed about any changes to FDIC insurance policies and rules. By understanding how FDIC insurance works and how to maximize your coverage, you can ensure that your deposits are fully protected. Alright, let's summarize what you learned in this video. In this video, you learned about an overview of Federal Deposit Insurance Corporation's insurance program, the types of account covered under FDIC insurance, and the limitations of FDIC insurance. Thanks for watching!